So this panel will focus on financing CCS. And this topic came up a lot today, and it comes up in all our conversations, how to direct investments in CCS in order to achieve the target for CCS, or the goal that we have for CCS technology to play in the climate mitigation. We need financial resources to invest in projects, invest in technology. Jared mentioned this morning that more than $1 trillion may be needed in the next 30 years to bring CCS to the level needed in net zero strategies. So there are lots of questions. How to generate these funds, where the money comes from, what are the business models, the role of government, the role of private sector. Currently, we see most of CCS projects funded either by corporate funds themselves or governmental support, either tax credits or subsidies. But we need to, and Jared mentioned this also this morning, we need to create an environment where private sector invests in CCS, where there is a level playing field, clear rules, and business case to invest in CCS. So I would like to introduce the panel today that will discuss all these issues, and we have a great combination of players. We have European Commission with us, Daniel Kitscha from DG Klima. We have US government, Adam Wong, he's Director of Strategic Engagement of US Department of Energy. We have two banks, Bank of America, Julian Mylchreest, Executive Vice Chairman, and we have Royal Bank of Canada, Eduardo Silva, Director of Renewable and Energy Transition, and we have Equinor, a private sector company, Torbjørg, Fossum, VP Global CCS Solutions. So as you can see, there is a great combination of players. So we can hear from the banks, we can hear from the governments, and we can hear from the player on the market. So we'll have a discussion here and then open up to you to ask your questions. So first I wanted to ask a question about balancing private and public investments, especially now at the kind of still early stages of the market development for CCS. We see private money going into CCS, a lot of interest, a lot of activities. Many players here are looking to develop projects, and we see also governmental support. And without governmental support, we hear nothing would have happened. So what is the balancing act, and how you see that maybe evolving in the future? So we'll start with governments. I'll start with Daniel to present the European situation, or your thoughts about this balancing in Europe.
Yeah, good afternoon, everyone. Thank you, Ellina, for the question. I mean, it's really sort of the core of what we and also my team do with the Innovation Fund. So the Innovation Fund is a grant funding program, so it's grants, but it's not grants for everything you need a grant for. It's relevant cost, 60% of that. So when we have 4.6 million tons of CO2 that will be captured in the Innovation Fund, that means there's a lot of private investment behind that, because all the other project costs need to be funded by the companies themselves or by investors. So in that sense, we see that for these front-runner companies that are really doing things which nobody has done before, there is certainly a risk here which needs public investments. And that's what we see also with the funding programs in the Netherlands, the funding programs in Denmark, that there is a need for really catching a little bit of this large, first-of-a-kind scale-up operations. But at the same time, we see a real private interest, private money interest in capturing CO2. We see the applications to the Innovation Fund. These are companies who come to us to apply for a grant with a project that is this big, and they want to capture. And why do they do that? Because, of course, in Europe, we have the ETS, and we have now an ETS reform that shows the downward slope of ETS allowances and the phase-up of free allowances for companies. And that is, I think, directly translated into the business case when those companies project themselves into the future. So in a way, there is certainly a need for governments and for public money to step this, to start these kind of investments in industry. But at the same time, we see industry already being very conscious of this being a necessity in several industries at least for those who are serious to be still there in the sites with their operations in a 2050 carbon-free economy in Europe. So that's where I would maybe stop here.
Yep. Thank you very much. Maybe I'll ask also Adam to share with us US experience. And again, on the same question, balancing private-public investments.
Yeah, thanks, Ellina, and thank you to the Institute for having me today. I think earlier this morning, Jared covered some of what the US is doing, so you all are familiar with it, and Director General Vanderberg actually made a reference, I don't think it was an endorsement, to the Inflation Reduction Act in 45Q. So I feel like you all already know everything, so I don't know why you need me. No, I'm just joking. It's an exciting time, really, for us in the US, and Jared had some of this on his slide. A couple of years ago, our Congress and President Biden, I think you all know this, passed the bipartisan infrastructure law. And with that, of course, overall it was $550 billion going to things we need, clean roads, clean water, improving our roads, improving our bridges. There was also $62 billion for us that was going to DOE. And of that $62 billion, $12 billion of it is actually going towards carbon management. So we see this as an opportunity really to help some of these projects, and it's really changed maybe the mission of DOE a little bit from going from the normal R&D approach to now like the deployment of these projects. So covered under it, and I know Jared had a little bit of this on the slide, there's about $2.5 billion for at least 6 commercial scale CCS projects. There's about 3.5 for at least 4 regional direct air capture hubs. There's also another 2.5 for carbon storage, looking at 20 to 40 sites that will be storing about 50 million tons a year over the next 30 years. And then also CO2 transport, $2.1 billion for our CO2 transport infrastructure. So really finding opportunities to fund the full scale of what's required in the CCS projects. But of course, not every project is going to receive funding under the bipartisan infrastructure law. So less than a year ago, our Congress also passed and President Biden signed the Inflation Reduction Act, which I'm sure many of you all are familiar with here. There's a number of areas under this that really might help some of these projects. For one, projects now have until 2032, so that's 10 years to claim this tax credit, giving them more certainty and time to prepare for things. There's also under it an opportunity for direct pay, which is really important for projects because now you don't have to worry about taxable income. You can get direct cash. You don't have to worry about investments. We're also lowering the threshold that is required for projects to qualify. So that really allows more industrial and small scale projects to participate in this. And finally, and the one the Director General mentioned is, of course, everyone knows this, is the pay, going up from $50 a ton for capture and geologic storage to now $85 a ton. So we're really excited about this opportunity, pairing both our bipartisan infrastructure law and our Inflation Reduction Act. And as you saw on the slide, anticipating, I think Jared had on the Princeton study, like 200 million tons of storage potentially by 2030, an increase of like 90 projects. So I think we're excited about this opportunity because we're hoping this will spur the next level of CCS projects in the US.
Thank you. So different models, but the message is the same. Government is supporting projects and leveraging private sector investments that are filling the gap of what government doesn't provide. But I'm wondering whether banks or private banks would agree with this. How much are you investing, or are you investing in CCS projects? Do you feel like this balance is right from your point of view? So maybe we'll start with Julian. Yeah, go ahead.
Sure. I mean, look, I think if we're going to crack it at the scale we have to crack it at, whether it's CCS or everything else, you're going to need private capital alongside public capital. So and I guess I'd include banks as part of that private capital in terms of what we deploy and also how we support our clients. I think the real question, though, is dependent on each technology. The debate I always have is like, well, where, when, and with what, on what basis is that capital deployed, right? Because I think that the first question is what capital? Is from a government standpoint, at the extreme, is it equity? And I was talking in one of the earlier conversations we had in the breakout room. Look at how the European gas industry got started with effectively state capital being involved and state entities playing a significant role. So that's the one extreme. The other, I think, is incentivizing the market, which I'd say is more where the EU is, and incentivizing capital, which is more where the US has been. And I think, look, particularly with something like CCS, I think when you think where where government can most usefully play, I would, not just because we're a US bank, but I think incentivizing the capital, I think, is actually the most significant kind of piece, because the market at the moment in general is wanting short-term returns, cash flow in 2 years, not long-term NPV. And I think that's something where if you deal with the capex, then I think things move faster. So, look, my answer from a government standpoint would I think more capex incentives, or even getting involved through state actors and entities providing equity direct. But look, for sure, the private capital has to sit alongside that. And then I think it's a function of doing things that I think the UK's government's doing well with a sort of RAB-based structure, where you actually say, look, I'll have a comfort to investors in terms of both debt and equity as to how you can look beyond changes of government and invest through the cycle. The only question then is, what's the right allowable return, given you're trying to drive and incentivize people to come in and take some more risk. So.
Thank you very much. Maybe Eduardo, let's hear from you.
Thank you, and to start, thank you, Ellina and the Institute for having me. Well, from my perspective, the math is quite simple. If you talk about $1 trillion of investment, the lion's share of that investment needs to come from the private sector, and that includes equity and the banks as well. But there's a question of timing when you talk about the maturity curve of the industry. Upfront, the risk is quite high. So this is appeals to the type of capital that's actually prepared to take that risk. That would be seed capital, venture capital, and government money. So when you look into the time scale from now to 2050, and the need that society has to invest upfront and trigger the industry, there will be a mismatch, temporal mismatch, between the source of capital. And I think the way this will work is the governments will enable projects, firstly by create the conditions for investment, but also to a certain extent investing money to start the first projects and create that learning curve that's so badly needed to make the costs more efficient. Then once this first project mature, then we're going to have a good chunk of equity moving into the mix, because equity investors will have the visibility that today they need. And down the line, when cash flows are flowing and the business models are more established, we're going to have much more of the bank's money coming in when the risk framework has been changed.
Thank you very much. And now, Torbjørg, maybe you sitting in the private sector, you kind of maybe using funds from the government, from the private sector, your own funds in corporate money to develop CCS projects in Norway. What is your view? How is it all playing together? And how you see, also maybe how you see that moving, what Eduardo said, maybe we are in a different stage now where we will be in a few years. And Norway is a pioneer in Europe and globally, so maybe you're already moving to that next stage.
Yeah, first of all, Equinor is an energy company based in Norway, and we are eager to move fast within CCS. This is important technology to fight climate change, and it's going too slow. We are only in the very beginning compared to where we need to be in just a few years' time. And when we are now building this business opportunity, we are also building on our years of experience in the North Sea. So we've been storing CO2 for more than 25 years. But I think even more important, we are kind of building on the experience we have from developing the Northern Lights project. But the Northern Lights project is a new business model. We heard about that earlier today also. It breaks up the CCS value chain. So we are testing and developing this new model where we are offering a transport and storage service to a third part, to industry that wants to decarbonize. And the transport and the storage part, that's where we are focusing. That's where we can play on our competence and leverage on that. And we are working hard to get down costs, because that is one of the key issues. And the single element that can get costs down is scale in the transport and storage part. So we are developing a CO2 pipeline from Seabush all the way to the Norwegian storages, and also from Wilhelmshaven. And by doing that, we can reduce that gap that exists today by more than half compared to cheap solutions. But we are also building our portfolio in the US, very much incentivized by the Inflation Reduction Act, and we do recognize that the incentives are very different We've talked about that here today in US compared to US. It's not working. So you didn't hear so much anyway. Yeah. But although the incentives are very different, it's very good that there are incentives and that they are developing fast now, because that was not the case 10 years ago. 10 years ago, it was the starting point was that the industry, the private sector, should develop the CCS business and manage all the technical and the commercial across value chain risk. And indeed, the private sectors, we can price risk when we have experience, when we have competence, when it is within our business model. But in these nascent industries, there are a lot of cross value chain risk that are very difficult to price due to the nascent status. And I think that is one of the area where we need to balance the private and public partnership. I think the question is very hard to answer, how to balance it. It's complex, and I guess that's why we are discussing it today. But I also saw, I was in the Blue Group, that we are getting more advanced and more concrete. So that was a good learning today.
Thank you very much. And you're right. I mean, there are lots of questions that haven't been answered yet. So, and hopefully they will be answered soon, but probably not here on the stage today. So we can continue kind of thinking off the top of our heads and improvise and kind of think out loud. And that's also advantage of this meeting, that brings together various players from different perspectives and different experiences. But several of you mentioned creating a market and incentives. So I wanted to turn again to Daniel in terms of, and also Europe, as we're focusing here mostly on the European situation. What are the regulatory, legal conditions that you think are driving or will potentially also drive scaled up market on CCS, like ETS, other regulations? Could you speak a little bit about that?
Yeah, sure. It's not to say that we have a market yet. So we are about to have one, maybe a couple of years away. We have financial close of these innovation fund projects. That would mean they have a contract with a storage operator, because that's a requirement before they can have a financial close. So I think from a European perspective, we see that we don't have things everywhere, so we need to have a single market solution. That's one of the aspects. The other is we see that different countries are already investing also into helping their industry to capture. And we have the ETS on top of it, which is, yes, it's an incentive to capture CO2. It's a different incentive than a tax break, to say it very clearly. But what we are what we need to start from is a strategic planning. So we need to know where are the things, where are the emitters, and we do this in the context of the CCUS strategy that my boss talked about, where our colleagues in our research department are doing revising a study that we did 10 years ago, defining or identifying the strategic trajectories that we would need on the continent in order to, let's say, be able to store a lot of Northern Europe's CO2 emissions in the North Sea, but maybe avoid that someone needs to ship their CO2 across the Alps to do the same, and sort of start from this. That's also the reason why we believe that the storage sites are the starting point for a sensible network planning, because if you know where those are and what capacities they have, you know how to dimension the other bits of the infrastructure. It was also mentioned earlier on today that, of course, there are dispersed emitters like the cement industry. And a pipeline doesn't make sense to every emitter in every place. That's why we have liberalized, I call it liberalized, in the ETS directive, the transport modes, where now any transport mode can be used. All of this, in the end, will only make sense if we have CO2 as a commodity. It's not the same type of commodity as selling oil and gas, but it will be a commodity, and it will be traded. And Kurt mentioned also that we're looking very hard at the feedstock aspects of a carbon economy, where we have a chemicals industry in Europe that needs to decarbonize as well, and we want them to stay in Europe also in a 2050 scenario. So I think in that sense, it's a very tricky challenge to do that if you are not a federal government, and you cannot just say, here's some money and here are the programs that you please apply to. So we need to have a consensus with member states, and that's where we really look at the national energy and climate plans, and we really look forward to, at the end of this month, see the drafts and see how, to what extent member states have taken this challenge on for their own industries and for their storage industries, if they have them, to have a plan. And then, of course, the cross-border links, there we have the benefit of an existing energy infrastructure program called the 10E regulation, and the Connecting Europe facility is the funding program underneath it, where we have the Institute of Projects of Common Interest, or Project of Mutual Interest, which means that several member states together have an interest in an infrastructure that has a cross-border dimension. And we have 18 candidate projects, 18 candidate CO2 transport infrastructure projects that have applied with the backing of several member states each to become recognized as one PCI or a PMI. And this for us is a very good sign, sort of a very good preview sign, so to speak, to say, look, there are a number of member states that take this seriously. And then, of course, once we see these projects, once we see the storage sites developing, maybe also on the basis of the target, then I think we have de-risked to a significant extent the business cases of the partners in that value chain.
Thank you very much, Daniel. Yeah, so it's just maybe to summarize, so you're saying that, well, there is a long-term goal for CO2 reductions and potentially storage for CO2. There is ETS price on carbon. There are different policies and support from the European Commission for infrastructure projects, for other projects, of CCS projects, that together as a portfolio of approaches will create conditions for the CCS market.
Yeah, it's a bit more serious than just that. Yes. We have a climate law that says we need to be by net zero by 2050. Right. And in the model, we know we cannot do that without capturing emissions and storing them. Yeah. And now we also know where the emissions are, and member states know where the emissions are. So the question now is just, okay, what solution do we need? Where do we need infrastructures in order to enable the solutions that member states want to have? Right. In the end, it's a question of, do we want to keep these industries here? If so, we need to help them decarbonize. If so, they need to have a way of capturing. That's an OPEX question. But for sure also storing, which is a CO2 transport and storage capacity question. Right.
And I would like to ask now, Julian and Eduardo, from your point of view, the CCS market, when we have it in Europe, what is it? What conditions are needed? How can we create commercially viable CCS market in Europe?
Well, I've said this to a couple of people in some of the prior sort of chats we've been having this morning. I don't think it's going to get any better than it is right now in terms of the frame that's been set in Europe or the frame that's been set in the US, right? I also think when you think of CCS, if it doesn't move fast in the next 3 to 5 years, I think the window's gone. Maybe people disagree, that's my personal view. So you kind of say, well, look, I still get a bit of a sense of everybody's, even, is it private capital, public capital? It's both. Should everybody doing stuff? Yes, everybody should be doing stuff. And it's a little bit like everybody's looking to each other a little bit to say, well, who's going to take more risk and less risk, right? Instead, it should just be, well, look, let's everybody get in the room and get on with it, right? Because I think, if you're a steel producer, you're trading at sort of 2.5 times cash flow. What better use can you do than take the bogey off your back of you're not going to be there in the future? I think you look at our ability as a bank to deploy capital at pace. It's not going to be supporting an isolated project and project finance. It's going to be funding the balance sheet for an Arcelor, a BP, a Shell, or everybody else through our balance sheet. Is that debt or is it equity? It's us funding our balance sheet, which we'll do in scale to make a company deploy capital. And I'd also say the same on the government side, as if governments really want it to move. Relatively speaking, you look at the IRA is amazing, and I think it's been a big force for good. But you look at it relative to the amount of capital that was deployed by the US government in the COVID Act in 1 year, that was 1.2 trillion versus the 800, maybe $1 trillion that will be deployed over the next 7 or 8 years as a result of the IRA. Massive shift, but again, we've got to decide where is government kind of capital being deployed. So for me, my challenge to everybody in the room a little bit would be, look, the geology is there. You heard that from the sort of three governments who were on the stage earlier. We've got a massive amount of capital we deploy if those projects move. But actually the hardest thing is actually that very first move. But once the first projects move, we can put a huge amount of capital behind in terms of refinancing those. And we're also bending our risk judgments a little bit where we're saying, look, if we want to tick normally 8 boxes, we'll tick 6 to make some of these kind of projects happen, right? And I think that's something, again, for corporates thinking the same way.
Eduardo, yeah.
Yeah, taking the perspective of investors we cover, it's back to that point I made earlier about risk framework. The EU ETS is a great start because it does create some signals on demand and enables innovation. So there are a number of smaller companies and big corporates that are developing teams. The fact there are so many companies and big companies with like talent and large teams looking at CCS is a start. So it's an investment, if you think of investment in a holistic sense, investment of resources, investment of time, and of course, investment of like those more the riskier capital that's able to price in this type of risk the industry has today. Now, the ETS isn't sufficient to bring in investment to that next level. And this is because of the structure of the investment needed for CCS. It's a lot upfront, large projects, and this is money that no one will be prepared to invest if there is no clarity and visibility on cash flows. So the European ETS needs to be complemented with policies that then enable that type of visibility on cash flows, and that may be like the UK government is implementing some type of contracts for difference structure, or it could be other alternatives that would enable the private sector to provide that backstop. But investors, I think, across the value chain will need the type of visibility to pricing, investing now to get that return back over a long period. And they need the visibility as well that these returns will be backstopped and guaranteed irrespective of the policy and the government that you may have in future in each one of the jurisdictions that people operate.
Well, thank you very much. And I wanted to ask Torbjørg experience of Equinor, because you did receive also support from the government for this project, but how do you see the commercial viable market for CCS?
So I think what we're seeing now is that the policy is firming up. It's getting clearer on the regulatory framework, and I also see that we see now a speed in the policy instrument developing. And with the Net Zero Industrial Act and the strong push for CCS and also the clear target, that is a very important starting point. But I do think there is still quite a way to go. and I think we should also make sure that we seek experience from UK. In UK, we have the 10-point plan with specific targets for CCS and other technologies. We have the initiated governmental processes that incentivize industry along all the parts of the value chain to develop projects along the same timeline, so it all comes together. But then not at least the active government that engage with the industries, the different part of the value chain again, to kind of help mitigate that cross-value chains risk that are really, really hard for the first projects. So a lot of, I think there's a lot of learning. Of course, UK is focusing on own emissions. Nations like Norway and Denmark and other member states will focus on also storing other nations' CO2. So then we also need to do it differently, because we need to also think about cross-border collaboration and topics like standardization and reporting schemes and regulation. We also need to think about that. So that's important.
Yeah, very good point. Yeah, I wanted to ask about ESG and green taxonomy, whether that plays a role. So maybe at the next round, if you could bring that up as well. But I wanted to give Adam opportunity not to comment on the on the European situation, but maybe you have some insights from the US situation that we can learn from. As was mentioned, UK is a good example. So I think we're all learning from each other. So maybe there is something in the US that we can pick up.
I recognize I'm the only non-European based person on this panel asking a question about the situation in Europe. I think at least my panelists have really hit it, where the ETS definitely provides, it's important for climate goals. It also provides that long-term certainty, I think, for the industry, for the financial sector as well. There was actually an article earlier this week in the Washington Post. I wrote down the title. It's Get Ready for Carbon Capture's Second Coming. And this article actually looked at both a little bit, it was a short article, but looked a little bit at both the EU and the US models. And what it really talked about, and some of my panelists have also hit this, that like different countries are going to have different approaches towards this, or different governments. And even in the US, we have 50 states that are not all the same. So I think we all recognize we have the same end goal towards net zero decarbonization, including CCS into that solution set. But at the same time, we might have a different pathway or a different incentive or policy to get there.
Thank you very much, Adam. So maybe another question I would like to ask is whether you see any difference in finding finances and investing in the value chain. So can we compare capture, transport, and storage? Are there differences in investments, differences in policy levers that are needed to direct investments in those different parts of the value chain? So maybe I'll start first with Torbjørg, and then the banks, and then Adam, and move to Daniel to close.
Yeah, I could share some perspective from the transport and storage perspective then. And I guess the starting point is that what are the key factors that we need to have in place to make an investment decision? And one of the key factors is that we need to be sure that there actually is a demand for the transport and storage service that we will offer. And the challenge today is, of course, the gap between what it costs to emit compared to what it costs for an emitter to implement CCS. And there are ways to close this gap. There is funding. There is contract for difference. There could be mechanism as public procurement, has also been mentioned here today, or a premium market. But also regulation of carbon market could play a role. And then a second factor that is important for us is that we are able to develop a solution at feasible, or an offer at feasible cost that the industry is willing to pay. And as I mentioned already, one way to do that is to develop a CO2 pipeline, to develop scale, because then we can get down costs by more than 50%. But to enable that, we need to make sure that there is enough CO2 gathered from one hub to make that investment. And it's going to be hard to fill up that pipeline from day one. It will fill up gradually. So how do we avoid that the first volumes, the first customers are not penalized? So that's another area for private and public collaboration. And the last point I would like to mention again is it is this cross-value chain commercial model to overcome the stages that we are in now, the nascent stages, and make sure that the private sector does not price risk too high because they are uncomfortable with it, or maybe not accept it at all, but find the balance on how we can share those risks now in the early phase.
Thank you very much. Yeah, and so if we ask Eduardo and Julian, do you see different risks associated with providing investments into capture, transport, and storage? How, in your view, how you see that picture? Yeah, Eduardo, maybe we'll start with you.
Yeah, I think the general framework for each part of the value chain has a common theme, that is there is a cost to implement a solution, and there is a benefit that may be a revenue coming from selling or handling CO2. Or you didn't mention utilization, could be selling products made from that CO2 as well. So there is this similarity, which means if there is visibility of cash flows, or there is a way to provide certainty on demand, that then you can price in a certain volume, and then policy that can backstop on price, then the archetype would be very similar across. But as of today, in the absence of that, the type of solutions we are looking at in terms of enabling financing for different parts are slightly different. And this is because, one, of difference of scale. So TNS tends to be bigger scale, like hub-based projects. And then it comes out infrastructure, or more for infrastructure type of investment. And then you're trying to find solutions to enable investment by infrastructure players. On the capture front, then on average, it tends to be more fragmented and then more decentralized. And then the type of investor that will look into invest in that type of propositions is very different. So in essence, there is a common theme, right? And once, I would say, the market's mature and the full industry is operating, I would say the framework is going to be very similar, but not at these nascent stages.
Thank you very much. Julian.
I think that last bit's the key. I think once everything's up and running, it's all going to look similar, but the challenge is how do we get it up and running and what are the challenges and all the different kind of pieces as a result, right? I mean, I think the risk capital, the equity risk capital, I think there have been enough good experiences of people backing stuff that's come out of Stanford, out of Oxford. I think, you look at that venture end of the spectrum of people looking at technology to capture. I think that's alive and well, at least all the way through to a kind of pilot stage. And I think you've got venture funds from the oil companies, the oil majors, the mining majors all ready to play there. So that's an active place. I think, likewise, I think you look at the storage end, I think there's enough incentives for the existing players that have got depleted fields that they're going to be ready to take more risk and to manage that and give themselves, frankly, another division that lasts longer than maybe their pure upstream division will live. So I think that also is going to, I think, work well. The challenge is the scaling up from pilot to big projects and then also the infrastructure piece, because otherwise I think you're stuck more in cluster developments where you're taking good real estate that's got good industrial clusters next to good geology, which frankly is the UK has chosen its first two places well because that's what you've got, right? But how do you replicate that and how do you grow beyond that to something bigger? And that's where I come back a bit to my challenge question earlier, which is the only way that infrastructure for me grows beyond the clusters and those integrated kind of chains is if there's a readiness of everybody involved to take more risk and get more involved to scale it. Because once you do that, trading will come in, multipliers will come in, lots of capital will flow, and you have liquidity. So that's really the conundrum, I think.
Great. So Adam, if I ask you, so in the US with 45Q, the incentive falls on the storage providers, and then it's passed through the whole chain. How do you see that kind of playing among the players in the whole chain, and how the government actually thought through that process?
Yeah, I think the storage aspect, that's one part of it. But of course, Ellina, as I also noted, we're investing in the full value chain because all parts of the CCS value chain are going to be important in this. I think, Daniel, your Director General used the word bottleneck to describe the situation in that, we could capture all the CO2 we want. If there's nowhere to store it, that's going to be a problem or issue. There's no point in doing that. I think Torbjørg, of course, Sleipner's got over 27 years of storage experience, and there's definitely an area opportunity for I think a lot of these countries, these governments to cooperate and exchange some of the knowledge that they've done in the past. My previous job, I was overseas in China. We're covering some DOE issues, and one of their projects there, they actually are trucking the CO2 because they don't have the pipeline developed right now. Obviously, that might not have the ideal business case. That's kind of expensive right now, but I think a lot of us are trying to figure things out as we go. One more thing I should give a plug on at least, and Carl and Juho mentioned is under the Clean Energy Ministerial CCS initiative, we do have a financing effort that includes active dialogues with the bank, with the industrial sector, and with the governments. Some CCS was never set up to fund projects, but those conversations, such as this, are a key, I think, step to bringing folks together and talking about these topics and issues and working together, because we all want these CCS projects. We all have a part and role to play into it, and it's working together.
Thank you so much, Adam. So Daniel, we'll turn to you, and we'll probably close this and then open up for questions. So if you want to maybe summarize from the European perspective, from the European Commission's perspective, how this all fits together.
Yeah, I mean, it's not for me to say how this all fits together. It's not that we have the solution. What we do have is we have seen how difficult joint risk-taking is between these value chain partners. We see that in the Innovation Fund projects where we have companies, big companies, I mean, these are not small companies, but having to not only talk to other companies, but also contract, but contracting on the basis of my operation of my plant depends on them performing, which is new to many people on the capturing side of things. On the other hand, we have done since the beginning of last year an activity together with our colleagues in DG Energy, the CCS Forum, which is a stakeholder engagement, but a stakeholder really discussion and working group. And there you can see that there is established industries that we have that have relevant experiences to do this, even though it's now CO2 and not something else. And there is, first and foremost, the energy infrastructure people, the gas infrastructure people. They say, look, we can design you a network. That's not a problem. We need to know where and how and what you need, etc. And there is also the oil and gas industry. Okay, they haven't stored, or maybe others than Equinor haven't stored a lot of CO2, but they know at least how to work wells and subsoil issues and have great knowledge about that stuff. So in a way, I think the de-risking needs to come from within the companies, where they say we have the knowledge and the experience to maybe embark on something like this. But then someone in a workshop we did on the 30th of March said his ideal sort of situation would be the partners in the value chain all holding hands and jumping together in a very cold water at the same time, which I think is the ideal. But in a way, we need to, as governments and commission, but also the member states, we need to sort of be there. Maybe if they cannot hold hands together, we need to be in the middle of this and say, let's do that. And it's exactly the timing challenge that I think is the relevant thing. Can I take a decision that depends on someone else going through with their project, basically? That's a key challenge. But again, when we look at the applications of the Innovation Fund, we see it's really sort of, it's sad to see that we cannot serve all of them because we are oversubscribed, but it's really good to see there's so much interest on the capturing side of things. And we have also capturing industries that say, look, we apply within transport and the storage infrastructure in one project because they want to do it like this. So we have one project in Bulgaria that will exactly do this. So in that sense, I think there's more to come, and I hope that sort of with these messages also speak to you guys in the banking and in the financing sector and saying there's more to come. There's already established companies seriously looking into these topics. But yeah, some bottlenecks need to be also on the horizon.
Maybe could I just add, I think to your question on the banks, I think if the banks see big clients that they know and trust jumping together and taking risk, then things will move, right? So that's part of what I was trying to say. So you put it better, but that's the key of it. Yeah.
It's a very good visual to leave us with and open up for the audience.
Jumping.
Bruno, you have a question? Sorry.
That I hold a mic. Question for Daniel. If CO2 is going to be a tradable commodity, how do you reconcile that with an ETS where emitters really are not liable only if they store the CO2? If you're going to have a tradable commodity, you're going to have middlemen, and middlemen taking ownership, taking liability of the CO2 to do with it what they want. Be it storing or using. So how can you reconcile those two?
Yeah, that's an interesting question. I think there's two parts of this question. One is that the non-existing CO2 market is the best regulated non-existing market in the world because we have the ETS and there are reporting requirements. And so you have emissions or you leak or you lose some CO2, you are liable under the ETS. Transport infrastructures and storage sites are by definition ETS installations. So that's at least the situation in Europe. The other answer is CCU. It's a much bigger, much more complicated life cycle problem. And so indeed, that's a much harder nut to crack for us to look at this CCU/feedstock aspect of it. Some of you might know that also in the ETS there is now a way of accepting CCU also as a non-emitted allowance-saving solution, but only if it's permanently chemically bound in normal use and after discarding. So it's a pretty high level for showing that there is a life cycle. This is something where we are working actively on the relevant delegated act. So that's part of indeed the the sustainable carbon cycles logic that we will need in our economy by 2050.
Thank you. I think there was a question here, Niall.
Thank you. I've got like a million questions, but maybe just to start. So, Julian, you seem to be really willing to take risks, which is fantastic. Things can go wrong, though. So, where do you sort of see the level of engineering or technical or delivery risk on CCS across the value chain? Because, you've got Gorgon, you've got, historical examples of things not going well. And then in the context of the US and IRA and 45Q, and, you have this transition from direct pay to tax credits, and how does that then affect your ability to provide upfront financing for those types of projects? Thank you.
I think that the frame I'd set more broadly is, in a lot of markets, when you're sat making credit decisions as a bank, your question is what happens to the market, and is it kind of growing alive and well? One of the good things, I think, when you think about a CCS business and a market, I have the same view on hydrogen, is if you build it and it gets to scale, you don't have the sort of question as to what that market's going to look like and is it useful and will it last, right? So there's the sort of credit risk of the sort of back end when we think about stuff is much less if you actually believe in the secular journey we're on. I think that's true across the renewables space, which is why as a bank, we made the commitments we have in terms of how much money we'll commit to that space. And then you want to say, well, if you're serious about it, you've got to work out how you do that. What's happening in the US, I think, is also helping manage that, because you're also de-risking or incentivizing at the front end where that risk sits with the sort of CapEx support. So, and I think, look, in a different way, you're getting the same from the innovation fund and other things. Yeah, so that you put all those pieces together, I think you can look at things in a different way. You still need so where are the risks still? I think the risks are, if you're looking at a project that's going from pilot to scale, that's still where the biggest risks are, which is why we're saying to mobilize capital, the easiest thing is to have 3 or 4 corporates drive that in the knowledge that they can talk to their banks before they commit, and in 3 years' time, we'll refinance, and then that recycles.
Thank you. Other questions? Paul, yeah.
Thanks, Ellina. Paul Zakor from Carbon Counts. I just wanted to take the opportunity to congratulate Daniel and his colleagues in Klima for the innovative Article 18 of the Net Zero Industry Act and the storage capacity obligation that it's trying to place on fossil fuel producers. And I've written about this quite a bit. I have a sense that I'd be interested to see what the panel think about transitioning that into an injection obligation on oil and gas companies, and whether that could solve any of these cross-chain risks where actually oil and gas companies or fossil fuel producing firms are actually obliged to start storing carbon, as well as emitting firms are obliged to start reducing and capturing carbon. Would that potentially solve some of these bottlenecks?
Do you want to take that? Should we maybe take a couple of questions and then come back? So we're running a bit late, so let's take maybe another 2 questions, if there are any questions, and then I turn to the panel and we'll conclude. Other questions? No. Okay. So maybe Daniel, turn to you, and then we'll finalize. Yeah. Oh, sorry. Okay.
Sorry. So again, Julian, earlier today, Matt Taylor here from Bayes was worrying about oversizing infrastructure and it being too costly in the long term and so on and so forth. So, could you imagine a world where banks would take that extra risk and help oversize infrastructure, even if today it doesn't obviously make perfect sense?
So 2 good questions on kind of also risks. Yeah, go ahead. Well,
Go first,
Daniel, do you want to start? Yeah,
Yeah, thank you. I mean, this is a proposal of the Commission, of course, so it's not just Kurt or me. But I think behind is the real belief that we believe this can become a market, that we don't need to regulate this from now on, and we don't need to force people to inject. What we do want to break is so this building a very small capacity, selling it, then building it, and then building a second phase, kind of a very sort of diligent but careful moving on. Rather a market where it's say, look, we build it, and then yes, we can have a 2 million tons a year additional customer, switch them on with a blast furnace the day after. So in that sense, we believe this is entirely up to the operators to fill it, to have the conversations, but the infrastructure needs to be located and built.
I mean, just to add on that and I'll answer your direct question, I think one of the opportunity we see going forward is once you get enough projects moving, particularly in the US, or where I think lots is already moving, and then hopefully more here. That's the key thing to make happen. Once you've got those several projects, the natural trading and connectivity between those projects, that people start thinking of CCS as a service and think, look, I'll just stand in the middle. I've got 4 projects in great real estate. I'll go and walk into BASF and tell them what I'm doing. That's going to happen, and that sort of stuff I think the market will love in terms of that next step. And then, look, in terms of the direct question now, sorry, say that again. What was the?
But risks.
Yeah, I mean, basically, could you imagine
overbuilding, sorry, yeah. I mean, look, I think you can tell from my last answer, I think, and you were also asking a question around risk and why we think differently on risk. I think you can be more comfortable overbuilding if you believe you've got that secular trend in the market. And if you believe when you build the projects, there's going to be a natural trading and business development that will happen, which will mean more will happen, right? I'm also a big believer that you're going to have some big sites out in the Middle East and elsewhere, and so trading between the Middle East and so on. So this isn't just managing a European business. It's, I think, going to become a global business as well. So that's how I would think about the risks, and particularly if you've got the comfort as a bank of good sponsors, and if you take the UK model again, a RAB-based model where you can see how that evolves, I think that's a powerful way to do it, because it gives you comfort on the returns over a period of time, and then there are going to be more and more projects starting to move. Answer your question? Yeah. Yeah.
Thank you very much. I think it was a very interesting, insightful panel. A lot of difficult questions. I think that was the most difficult panel of today's. Always very difficult questions. But I'm kind of leaving this panel with a positive, I think, takeaway, because governments are working really hard to de-risk. We know CCS is necessary. It is an important part of the strategy for the US, for Europe, for European Union. So governments are doing a lot of things. As Daniel said, more to come. And private sector is willing to take the risk. So we hear that loud and clear as well. And this analogy of, kind of holding hands and jumping into cold water together seems, again, as a positive message, but every part is working hard to actually meet each other middle way and then jump into this. And I think we're already jumping in it together. So yeah, thank you so much for all your insights, for your experiences, for your work on this. Yeah, thank you, and a lot of applause for